the example above, along with the accounts of the majority owner, but to add an entry on the financial statements for minority interests. The financial accounts are lumped together with the parent, and both the equity and the equity in earnings attributable to the other shareholders is accounted for with a single line item. 20% to 49% ownership. With this level of ownership, the accounting treatment is like the minority interest accounting above, only the parent company in question is the minority owner. To use a Berkshire-specific example, Blue Chip Stamps was accounted for in this way until Berkshire's investment crossed the 50% threshold with the diversified retailing merger. Prior to that time, the only entry attributable to Blue Chip was an equity in Blue Chip Stamps, representing Berkshire's proportional ownership in Blue Chip, and a similar entry on the income statement, accounting for its share of earnings named Equity in Earnings of Blue Chip Stamps. Less than 20% ownership. This is where economics and accounting diverge. Accounting rules dictate that only the dividends received from an investee in this class can be counted as income. To use an oversimplified example, if Berkshire owned 19.99% of a company with $100 in net after-tax earnings, paying out no dividends, it would record no earnings from this investment. If instead it owned 20% of the same company, it would record an entry for equity in earnings of XYZ of $20. It's the same economics, just drastically different accounting. Berkshire's insurance companies own significant amounts of stock, many of which fell into the last category, and since many of these investees retained most of their earnings, in other words, paid out little of their earnings as dividends, the income did not appear in Berkshire's financial statements. In fact, Berkshire's share of the income of these investees, called look-through earnings, were larger than the total reported operating earnings of Berkshire. To paint the mental picture, Buffett described a large iceberg mostly hidden below the surface of the water. The substance was there, one just needed to look more closely to see it. Buffett warned shareholders that his views were unconventional. He needed them to understand that he focused on the economics, not the accounting. Buffett showed he could immediately increase Berkshire's reported results, even though such an action tempts us not at all. All he would have to do is sell Berkshire's equity portfolio and use the proceeds to buy long-term, tax-free bonds. Such a move would increase accounting earnings by over $30 million, representing over 50% additional after-tax reported earnings. But it would also be detrimental to Berkshire's economic position, since its claim on the underlying earnings of companies in the equity portfolio were worth more. As a controlling shareholder in Berkshire, Buffett could follow the path that made the most sense in pure economic terms, rather than be tempted by the apparent prosperity allowed by accounting. As it turned out, inflation peaked at 13.5% in 1980. Buffett likened inflation to an implicit tax on capital. When combined with the explicit income tax, an owner of a business, even a very good business, could lose purchasing power. The example Buffett used was a business earning 20% return on equity in a world of 12% inflation. Someone in the 50% tax bracket would, if he or she was paid out all earnings as dividends, end up with a 10% after-tax return and lose 2 percentage points of purchasing power a year. Since Berkshire was not immune to inflation, Buffett wanted shareholders to be aware of its pernicious effects, even if it had no solution to the problem. Sources of earnings. Berkshire's pre-tax operating earnings increased 16% to $54 million. See Table 4.2. The primary driver was improved results from insurance, presented in more detail below, followed by increases at Seas and Blue Chip Stamps. To provide Berkshire shareholders with as much relevant information on their investment as possible, for several years Buffett had included the letters to shareholders from its major investees, Blue Chip Stamps and Wesco, at the end of the Berkshire's report. The letters were penned by Chairman Charlie Munger and Louis Vincenti, respectively. In 1980, both told the story of Wesco's divestiture of most, 15 locations, of its mutual savings branch network. The sale resulted from a desire to mitigate the effects of inflation on a borrow-short, lend-long operation like a bank. The sale of the branch network, save for the bank's headquarters office building and one satellite branch, was motivated by the margin of safety considerations intrinsic in engineering and still appropriate, we think, in financial institutions, to reduce an earthquake risk, according to Munger's letter to Blue Chip shareholders. The buyer of the branch network was Brentwood Savings, another local savings and loan institution. The sale consisted of the transfer of $307 million of savings account liabilities, an equal amount of mortgage loans, and the physical assets of the branch offices. It resulted in a net pre-tax gain of $5.9 million to Wesco, $2.8 million pre-tax to Berkshire. Though the transaction would reduce Wesco's average yield on its assets from 9.3% to 7.7%, it would come with a significant decrease in leverage and, importantly, help protect Wesco from the ravaging effects of inflation. The sources of earnings table presented in the Berkshire report took pains to separate the gain on the sale from Wesco's operating results. Berkshire's investments in non-controlled businesses, those in the less than 20% category, had a combined market value of $530 million and a cost of $325 million. At $13 million, the combined earnings attributed to Berkshire's ownership interest in Aluminum Company of America, Alcoa, and Kaiser Aluminum and Chemical Corporation were larger than most of Berkshire's wholly owned subsidiaries. Those investments made up 10% of Berkshire's equity portfolio at market at year-end, but their full economic earnings did not show up in financial statements due to conventional accounting rules. Another much larger non-controlled investee was Geico. Berkshire's 7.2 million shares represented a 33% interest in the insurer, and its earnings attributable to Berkshire that 1 year were $20 million. Berkshire bought the shares for $47 million in 1976, and 4 years later they were worth $105 million, 20% of the portfolio. Buffett used Geico to show how the stock market frequently provides opportunities to buy great businesses at less than private market values. Buffett said buying a similar ownership interest in $20 million of earnings would cost at least 10 times as much. Yet Berkshire was able to acquire its shares in Geico at a bargain price and was content to let management run the business as they saw fit, including choosing the dividend policy. One quirk related to Berkshire's investment in Geico should be noted. Normally, a 33% ownership interest would call for the investee accounting treatment, with Berkshire's proportional interest in earnings reported on the income statement. But because of Berkshire's other insurance holdings, it had transferred its right to vote the shares to an independent party. This special order from Washington, D.C. and the New York insurance departments allowed Berkshire to own more of Geico than it otherwise could have, but necessitated an accounting treatment similar to that of a non-controlled business, reporting only its dividends and earnings. Insurance. The insurance industry turned in a year similar to Buffett's prediction. The industry combined ratio was 103.5% in 1980, which meant its float, monies held but ultimately destined to policyholders and others, cost 3.5%. This was not a terrible result given that interest rates at that time were in the double digits. In fact, some managers outside of Berkshire rationalized the writing of business at a combined ratio over 100% for that reason. The same interest rate environment was causing other, even more irrational behavior within the investment portfolios of some insurers. An environment of rising interest rates generally has a negative effect on bond prices. This is because a lower price, denominator, is needed to cause the same coupon payment, numerator, to represent a higher ratio or yield. In an equity portfolio, these declines in market price would be reflected as a corresponding decrease in book value. For bonds, they were carried on the books at amortized cost, effectively protected from market swings on paper. An insurer couldn't sell a lower-yielding bond, even to trade to a higher-yielding issue, without incurring a capital loss. At best, some held on to avoid the potential embarrassment of showing a loss on the income statement. Others were forced to maintain the investment since realizing losses would have reduced an already thin shareholder equity account. The bond portfolios of most insurers were usually multiples of shareholder equity and were typically funded primarily by policyholder premiums. The insurer was thus incentivized to write business at any cost to maintain its float. The rational course when reporting underwriting losses would be to realize the capital losses and move into taxable bonds to capture a higher after-tax yield. Berkshire was not immune to the above scenario, and Buffett even chided himself for not acting earlier to sell unattractive bond holdings at a loss. Berkshire was protected in two ways. First, its investment portfolio had a higher concentration of equities and a corresponding lower concentration in bonds. Second, Berkshire's insurance businesses wrote far less volume in relation to equity capital than its peers. Its $185 million in premiums written amounted to just 56% of average ending equity of $331 million. Furthermore, its bond portfolio represented just under 50% of equity capital at year-end compared to 300%, or 3 times, for other insurers. This meant any losses in bonds had less impact on Berkshire's capital. Still, as Buffett noted, troubles for the industry mean troubles for us. Buffett gave a frank assessment of Berkshire's insurers. National Indemnity continued to produce good results under a self-imposed reduction of premium volume due to insufficient pricing. National Indemnity's reinsurance business reflected the ongoing weaknesses of the primary market and wasn't expected to have much future growth. Buffett said the delay factor in reinsurance caused him to bemoan industry conditions that were transforming the reinsurance market into amateur night. People were lured by ease of entry into the business, large amounts of upfront cash, and delayed expenses. It set the stage for even larger swings in profitability and required a significant amount of discipline over many years. Even so, the small underwriting loss in reinsurance during 1980 was a very good result considering its associated float, assuming business on the books was appropriately reserved. With the exception of a good performance in Kansas, home state insurance operations were poor. Results were so bad in Iowa that the Insurance Company of Iowa, founded in 1973, was shut down and merged into Cornhusker Casualty. With much negative industry information to report, Buffett apparently forgot to mention that Berkshire's own insurance companies collectively turned in a great year. The combined ratio improved and a record underwriting profit was achieved. This was on top of a nearly $31 million of investment income. Nonetheless, Buffett again left off with a prediction for the following year. He anticipated lower volume and poorer underwriting results in 1981, but that Berkshire's results would be above the industry average. Textiles and retail operations. In 1980, the report on Berkshire's textile operations and its associated retail operation was moved away from the beginning of the letter. That was because the scope of the textile business was reduced. Buffett informed shareholders that New Bedford's loom capacity was reduced by 1/3 and that operations ceased at Wambeck in Manchester, New Hampshire. The rest of the operation was split into independent manufacturing and sales divisions. Even though the textile group had more than doubled capacity in our most profitable textile segment through a recent purchase of used 130-inch sour looms, capital employed in the segment was being reduced. Though lumped together in the same segment as the faltering textile operations, Buffett praised Associated Retail. He noted that in 1981, Associated Retail would celebrate 50 years in operation, all under the leadership of Ben Rosner. Illinois National Bank and Trust of Rockford. The news on Berkshire's banking subsidiary, Illinois National, was doubly sad. First, Berkshire was forced to divest of the well-run and highly profitable bank, which was completed on December 31, 1980, to comply with federal law. Then its founder, Eugene Abegg, died on July 2, 1980, at the age of 82. Buffett had much praise for Abegg and fondly recalled their 11-year business relationship. As a friend, banker, and citizen, he was unsurpassed, said Buffett. Buffett admired both Abegg's under-promise and over-deliver business approach and his strength of character. The seller has dozens of opportunities to mislead the buyer, yet he laid all negative factors face up on the table. Yet Abegg hid, or forgot to mention, positive factors that came with Berkshire's purchase when they periodically materialized. Buffett's praise read like a business obituary, though the business was not dead, and eulogy wrapped together. Abegg started the bank in the 1930s at the request of George Meade, no known relation to the author, a wealthy industrialist at the time. He ran it for close to 50 years, producing record industry results. When other banks were failing or trying to figure out how to pay depositors after the one-week bank holiday of 1933, Abegg had enough cash on hand to pay all depositors in full. His fiduciary attitude was almost dominant, said Buffett. High praise indeed. The financial divestiture of the bank was complicated but designed in the best interests of both Berkshire shareholders and those of the bank. The divestiture would not be entirely financially motivated. Buffett wanted to reciprocate the fair treatment received by ABEG in the purchase and operation of the bank with an equally fair sale. Though the mechanism was somewhat complex, the process amounted to an I cut, you choose type of split. As the controlling shareholder in the bank and Berkshire, Buffett designed the exchange ratio. Since he designed it, he left himself as the exchanger of last resort. Berkshire's 1,300 shares were left with three options. Proportional option, maintain an equal ownership in Berkshire and the bank post-divestiture, with only difference being having two stock certificates after the divestiture, chosen by 24 shareholders. Bank preferred exchange, increased ownership in the bank while decreasing ownership proportionally in Berkshire, chosen by 39 shareholders. Berkshire preferred exchange, reverse of the second option with ownership increasing in Berkshire and ownership decreasing up to the entire amount in the bank, chosen by 1,237 shareholders. The bank was left with 65 shareholders, all of whom chose to become a shareholder. Because the divestiture was accomplished via a transaction to existing Berkshire shareholders, its equity on the books of Berkshire was removed in a treasury shares transaction, which gave the appearance of Berkshire repurchasing 41,086 shares for nearly $29 million. Financing. During 1980, Berkshire sold $60 million of 12.75% notes due August 1, 2005. The bonds contained a sinking fund arrangement that would take effect in 1991. A sinking fund is a technical term for money set aside to repay a debt in regular installments. It's a lot like a monthly mortgage payment of principal and interest. Unlike a conventional mortgage, however, corporate debt often contains unique provisions. In this case, Berkshire would have use of the original $60 million from 1980 until 1991, and during that time would only be required to remit interest payments. In 1991, the loan would start amortizing, meaning the principal would begin to be repaid. Such a provision decreases the risk to a lender. It allows the debt to be repaid over a known period rather than relying on a new loan to repay the full amount once the original loan comes due. Even though Berkshire did not have an immediate use in mind for the proceeds, they were raised in anticipation of opportunities arising. Buffett was thinking into the future, knowing full well that the time to borrow money was when one didn't need it. 1981. Berkshire's after-tax operating earnings of $39.7 million in 1981 produced a 15.2% return on beginning equity capital at cost. Maintaining such a rate of return would require favorable opportunities to purchase more businesses in whole or in part via the stock market. Given this, Buffett laid out Berkshire's acquisition strategy. Berkshire was okay with either total ownership of a business or part ownership in the form of marketable securities. He went so far as to say many of Berkshire's non-controlled investments, stocks, were better than its controlled businesses because of the mispricing opportunities presented by the market from time to time. In either case, no attention was paid to accounting over economics. The economics won out every time, even if the earnings attributable to Berkshire's share never appeared on financial statements. Combined, these unreported but economically real earnings already exceeded Berkshire's reported earnings and were why Buffett took pains to illustrate what was going on. 4 of Berkshire's investees are good examples. Geico, General Foods, R.J. Reynolds Industries, and the Washington Post had combined undistributed earnings attributable to Berkshire totaling $35 million. This was over half of Berkshire's 1981 earnings before interest. Though very little of that money appeared on Berkshire's financials because of low dividend payout ratios, it would eventually show up as capital gains as the market recognized the accumulating value in the underlying businesses. In the short run, the accounting could skew down the annual return on equity calculation, but over time it would show up in the book value for Berkshire shareholders. Buffett looked down on companies that preferred accounting over economics, but he understood why managers made that choice. They were type A personalities who seldom are deficient in animal spirits and often relish increased activities and challenge. These managers, Buffett said, knew exactly where they stood on Fortune magazine's Fortune 500 list of largest companies by revenues. But how many knew their ranking based on profitability? Few, he conjectured. These managers would buy the proverbial toad they thought they could kiss and turn into a superstar. A few managed such a feat, and Buffett named them. Ben Heinemann at Northwest Industries, Henry Singleton at Teledyne, Erwin Zabon at National Service Industries, and especially Tom Murphy at Capital Cities Communications. Murphy got extra praise for being skilled in both acquisitions and operations. Notably, Buffett explicitly excluded himself from such managerial accolades. The topic of inflation remained a concern as the rate of inflation continued to run near double digits. Buffett said inflation acted like a gigantic corporate tapeworm, consuming investment dollars regardless of the health of the host. The less prosperous a business, the greater proportion of dollars were consumed. Not only would taxes and inflation combine to reduce individual investors' real purchasing power over time, businesses would be forced to retain earnings. To maintain unit volume over time required continual reinvestment in capital such as receivables, inventories, and fixed assets. One of the worst parts about inflation was its distorting effects on managerial decision-making. Reductions in purchasing power and forced reinvestment were real issues. The problem, it seemed, was that some managers and owners did not make decisions that took inflation and changes in interest rates into account. Sources of reported earnings. The now familiar table in the chairman's letter, see Table 4.2, gives a broad look at how the budding Berkshire conglomerate fared during 1981. Action was concentrated in two areas, insurance and candy. Insurance dominated 85% of the year's pre-tax operating earnings. Insurance underwriting, which was viewed and managed distinct from investment income, declined but was still profitable. The underwriting profit, together with an increase in net investment income, was enough to bring the insurance group's total contribution to pre-tax operating earnings above that of the prior year. Such a comparison is slightly misleading since Berkshire had used $28.75 million of its $60 million of proceeds raised the prior year to add to the insurance group's equity capital. See's Candy's $12.5 million of pre-tax earnings, Berkshire's share, representing over a quarter of the total, jumps out as the second largest contributor. In his letter to blue chip shareholders, Charlie Munger described See's in more detail. The figures in Table 4.25 showed a modest annualized increase in pounds. The ability of See's to pass on increases in prices, however, resulted in double-digit growth in revenues and even greater increases in profits during that time. In 1981, profits at See's increased 41%. Such increases were that much more impressive, said Munger, considering the industry was basically stagnant. Why was this so? Munger, always one to seek out the why behind any result, good or bad, attributed the success of See's to a couple of factors. First, customers preferred its taste and texture over the competitors. This was likely the result of its fanatic insistence on expensive natural quality control and cheerful retail service. Second, See's controlled the distribution of its candy very carefully, owning all its stores and handling distribution to those stores itself. See's was therefore rewarded, said Munger, with extraordinary sales per square foot, frequently 2 to 3 times those of competitors. With such excellent business attributes, See's was clearly worth far more in excess of the $38.3 million carrying value Blue Chip attributed to it on the books. The remainder of the Berkshire sources of earnings in 1981 made up just 15% of the total, but some were of interest. After divesting its branch network in 1980, Mutual Savings and Loan lived up to expectation and saw its pre-tax earnings drop from $2.8 million to $0.8 million. The Buffalo Evening News, a subsidiary of Blue Chip Stamps, continued to struggle with litigation issues from its competitor and turned in a loss of $0.7 million for Berkshire shareholders. Shareholders would also have noticed the jump in interest expense. A direct result of the $60 million borrowed in 1980, interest expense jumped from $9.4 million to $12.7 million in 1981. Insurance. Irrational pricing by insurance industry participants in 1981 continued throughout the year and gave Buffett the confidence to predict in his chairman's letter, written in early 1982, that 1982 will be the worst year in recent history for insurance underwriting. Industry data, see Table 4.26, showed a correlation between the yearly change in premiums written and the impact on profitability the ensuing year. In an inflationary world, low increases in premiums meant insurers weren't covering their costs, and profitability, expressed in a combined ratio above 100%, was trending the wrong way. Over the preceding 3 years, premium growth industry-wide fell to single digits. Consequently, the combined ratio deteriorated. Based on then-current trends in quarterly data, which were quickly deteriorating, things were expected to get much, much worse. Because of the open book nature of the insurance industry, rates were generally subject to the actions of the least rational competitor. That is, that outfit would attract the most business and others would feel the need to follow. Berkshire, unwilling to write business at an obvious loss, wrote almost 20% less in volume in 1981 compared to 1980. Part of the decline came from shuttering the Iowa home state operation during 1980. Shareholder-designated contributions. Berkshire's new charitable giving program was the brainchild of Berkshire Vice Chairman Charlie Munger. It gave Berkshire shareholders the option to designate contributions to any charity with the amount based on the number of shares they owned. Berkshire set the per-share amount. This option was limited to shareholders who owned shares in book name, that is, directly registered and not through a broker. In the first year, 90% of shareholders, 95.6% if Buffett's own shares were included, elected to participate. In total, $1.8 million was paid to 675 charities. Berkshire was effectively paying a tax-free dividend to shareholders that was immediately sent to their favorite charity. 1982. Buffett's prediction of a poor year for insurance underwriting came true. This, in addition to 2 other factors, caused this benchmark return on beginning shareholders' equity to come in at 9.8%. This subpar number was reported in the very first sentence of his 1982 chairman's letter. The 2 other factors contributing to the decline were the growth in the equity capital base and higher levels of investment in non-controlled businesses. Maintaining high rates of growth on Berkshire's capital was more challenging with each passing year. Berkshire's practice of retaining all earnings resulted in capital accumulating much faster than at other businesses that paid a dividend or regularly bought back shares. Accompanying, and in part because of, Berkshire's large and growing investment in non-controlled businesses via the stock market, Berkshire's reported earnings did not fully reflect actual economic earnings. The iceberg Buffett described in a previous letter was growing, but it was doing so largely below the surface. For this reason, Buffett proposed a change to his preferred yardstick. Instead of looking at the ratio of operating earnings to beginning equity capital, valuing securities at cost, he suggested the annual change in net worth or book value, valuing securities at market. This measure would allow the retained earnings of non-controlled businesses to show their worth, albeit with stock prices gyrating year to year around their intrinsic value. Buffett provided several examples to back up his rationale for changing his yardstick. The 4 companies mentioned in the prior report, Geico, General Foods, the Washington Post Company, and R.J. Reynolds Industries, had earnings of $54 million attributable to Berkshire in 1982. Yet only dividends showed up on Berkshire's income statement, so only $14 million of the earnings were included. Geico only contributed $3.5 million after tax to Berkshire's accounting earnings. An additional $23 million of Geico's undistributed earnings remained below the surface. A large portion of Berkshire's economic earnings and many other non-controlled businesses in the $921 million equity portfolio were similarly hidden. This new yardstick proposal by Buffett raised the only 9.8% return to 40%, since the gain in net worth came to $208 million, a whopping 6.6 times the $31.5 million of accounting operating earnings. Buffett came right out and said what he would have been thinking if he were in the shareholder's shoes. You should be suspicious of such an assertion. Yardsticks seldom are discarded while yielding favorable results, he said. We generally believe in preset, long-lived, and small bullseyes, not shooting the arrow of business performance into a blank canvas and then carefully drawing the bullseye. Buffett's logic was sound, and for Berkshire it made sense to readjust the performance gauge to make up for the vagaries of financial accounting. Sources of reported earnings. Sticking out like a sore thumb, the $21.6 million pre-tax underwriting loss from the insurance group was enough to put a pit in one's stomach. The swing to a loss, though anticipated, was still hard to comprehend. One positive factor within insurance, which will be discussed in more detail below, or at least a mitigating factor to the large underwriting loss, was the $41.6 million of pre-tax net investment income in 1982. It must have been somewhat comforting knowing the insurance business overall was profitable. While still reporting operating losses, $0.7 million pre-tax attributable to Berkshire that year, the success of the Buffalo News in attracting Sunday readership presaged good things to come. The News had grown Sunday circulation to 367,000. This was an incredible feat given that 6 years prior it had no Sunday edition. Further, when Sunday was entirely served by the News competitor, the Courier Express, the circulation was just 272,000. In a market with very little household growth, these figures pointed toward the value subscribers found in the paper. The managers Henry Urban, Stan Lipsey, Murray Light, Clyde Pinson, Dave Perona, and Dick Feather were singled out by name in the chairman's letter. Another entry in the same sources of earnings table would have stuck out. Mutual Savings and Loan, the now one headquarters, one branch bank owned through Blue Chip's Wesco subsidiary, had lost money pre-tax, Berkshire's share was $2,000, no zeros omitted, but had generated an after-tax profit of over $1.5 million. What was going on? Charlie Munger explained this in his report to Blue Chip shareholders. He told shareholders that the peculiar result of pre-tax loss and after-tax gain was of less than highest quality, since it arose due to tax savings as part of being consolidated for tax purposes with Blue Chip. Munger also pointed to another quirk. Mutual Savings and Loans operating earnings, notwithstanding the tax boost, earned just 7.1% on its $46.2 million of beginning shareholders' equity. Because Blue Chip purchased its interest in Mutual Savings and Loan at a discount, its rate of return was 18.1%. Mutual Savings and Loan operated a lot like Illinois National Bank and Trust, the bank Berkshire was forced to divest 2 years prior. Mutual Savings and Loan had a policy of holding high levels of equity in relation to interest-bearing deposits, a high percentage of assets in short-term cash and cash equivalents, and above-average amounts of assets in tax-exempt issues, yielding more than typical mutual banks' mortgage portfolios. During 1981, deregulation of banks and thrifts unleashed changes and stiff competition that Munger likened to a hurricane. Mutual Savings largely escaped damage because it shed its branches in 1980 and because of its conservatively operating philosophy. Blue Chip's two other major subsidiaries, See's Candies and Precision Steel, had divergent years. See's did well, Precision Steel did poorly. See's is by far the finest business we have ever purchased, wrote Munger. Its earnings rose 13.4% to $14.2 million in 1982, continuing to benefit from the fanaticism described in the account of 1981 above. Although it still reported a profit, Precision Steel suffered due to a severe recession in the industry, on top of an unprofitable precision measuring tool line closed at an after-tax cost of $650,000. Textile results improved over 1991, though textiles still lost over $1.5 million pre-tax. The business continued to shrink. Sales were $21.8 million and total assets just $12.9 million, including inventories of $4.4 million. Receivables were not separately detailed. The group was literally fading to a footnote. Insurance. In every area of business, volume was down, and all but one group, workers' compensation, turned in an underwriting loss. Two major killers were National Indemnity's specialized auto and general liability and the reinsurance business. Berkshire's insurance underwriting deteriorated far more than the overall industry in 1982. As was his style, Buffett did not sugarcoat this fact, he stated it plainly. In the reinsurance line, underwriting losses jumped for two reasons. First, storms in the U.S. Southwest during the beginning of 1982 caused immediate claims. The second was adverse loss development. The nature of reinsurance is that claims stretch out over years, yet management must make an initial estimate of all future costs immediately, regardless of how far in the future they are expected to be incurred. When those prior year loss estimates change, as they did for Berkshire's reinsurance business during 1982, loss development charges are booked in the year the adjustment is made. Adverse loss development occurs when initial estimates of costs are found to be too low. The long time horizon is good from the standpoint of creating long-lived float, but management's estimates are subject to optimism at best and outright deception at worst, frequently leading to inadequate reserving. Competitive pressures not only kept rates down industry-wide, but allowed risk to increase as well. National Indemnity's specialized auto and general liability segment had a massive swing in underwriting profitability. Berkshire self-admittedly accepted some of this business. It tried an undefined attempt to counter the adverse trends which, in retrospect, but still without explanation, were ill-conceived and poorly executed. The Home State Group continued to struggle with profitability. Underwriting was so bad in Minnesota that Berkshire closed Lakeland Fire and Casualty Company, the entity formed in 1971 to conduct business in that state. The Workers' Compensation Group was the only ray of sunshine. It turned in a fourth consecutive year of profits. Berkshire's 115% combined ratio in 1982 was bad in its own right. It was even worse compared to the 109.5% ratio Buffett estimated for the industry overall. And it would be a bloodbath in just a few more years if trends continued. Buffett called the industry average estimates a best case. Because of the significant discretion management had in estimating future losses, much mischief could be done. Buffett did not name names, but said several other insurers used questionable accounting in 1982 to lessen the blow of the significant losses affecting the industry. Buffett put it bluntly, in insurance, as elsewhere, the reaction of weak managements to weak operations is often weak accounting. His dig continued with one of the aphorisms he was known for. It's difficult for an empty sack to stand upright. Others thought the weaknesses in pricing would subside and move toward better profitability, just as in other insurance cycles. But not Buffett. He foresaw continued losses in 1983 and 1984. Insurance was a commodity-type business with ease of entry. Its very nature of delayed recognition of the profitability of underwritten business caused overcapacity to arise more often than not. Also, there was no government-imposed prices. Industry participants were free to price as they please. Such unrestrained competition hadn't always ruled. In decades past, such as between 1950 and 1970, the industry averaged a 99% combined ratio. Buffett said the industry then worked with a legal quasi-administered pricing system fostered by insurance regulators, where competition was not pervasive. If they became unprofitable, all participants would work in a gentlemanly manner to correct them. Insurance companies were in fact prevented by law from undercutting one another on price. That day was gone, and the only way to correct the misery was to decrease industry capacity, meaning supply. Issuance of equity. The very first sentence under a section entitled Issuance of Equity foretold the future. Berkshire and Blue Chip are considering a merger in 1983. That should have made readers sit up and pay close attention. Buffett did not expound on the merger itself. Instead, he described share-based mergers and acquisitions in general and the all-too-often value-destroying practices they produce. Remember the metaphor about mergers being a business marriage? The wise would not go into marriage without a lot of thought and knowledge. Buffett's long explanation of mergers was his way of sharing knowledge. Commenting on Berkshire's policy relating to share issuances, he said, "Our share issuances follow a simple basic rule. We will not issue shares unless we receive as much intrinsic business value as we give. Don't all other managers act in such rational manner? No. Quite frequently, Buffett explained, one or a combination of the manager's thirst for deals or the valuation of either side of a merger caused value-destructing action for one of the parties involved. Most often, it was the acquirer that engaged in value-destroying practices, usually by issuing undervalued shares or overpaying for a target, but it's possible for either side to destroy value. Buffett used the example of a family farm. A hypothetical merger of a 120-acre farm with a neighboring 60-acre farm would result in a 180-acre farm. The merger provides an equal partnership between the two farmers. Yet this calculation sees the owner of the larger farm experience a 25% reduction in ownership, from 100% of 120 acres to 50% of 180 acres, or 90 acres pro rata. This happens all the time in business mergers. Even if the two farms were of equal size, their relative valuations could cause a value-destroying result. For example, if one of the two farms were selling for half of their worth, the result would be the same as the scenario Buffett described above, since the undervalued side would be giving up more than they were getting. Buffett thought managers and directors should ask themselves if they would sell 100% of the business at the same valuation as they were considering selling part of it. This train of thought was identical to that used by Buffett in buying less than 100% of a business, public or private. Start with the valuation of the whole and then split it into pieces to determine the per-share price one is willing to pay. The crux of the issue was that CEOs had different incentives than owners. By using stock rather than debt or cash, he, for the vast majority of CEOs at the time were male, would end up with more kingdom to manage at the expense of owners. Such mergers or acquisitions were frequently done on the basis that either future business value would materialize, growth for growth's sake was needed, or for perceived tax reasons, giving some consideration in stock because the manager had to. Buffett was priming his shareholders for the proposed blue-chip merger and letting them know he would act in their best interests. He reminded them that the only such merger under his management of Berkshire that caused the issuance of shares took place in 1978 with the merger of Diversified Retailing. With the impending blue-chip merger, Buffett promised to not equate activity with progress or corporate size with owner wealth. Since Buffett was Berkshire's largest shareholder and therefore proportionately affected by all capital allocation decisions, minority partners should have felt ease about having him at the helm. Businesses wanted. Buffett's 1982 chairman's letter included a short advertisement. This was the first of such advertisements, not for product, but rather for business acquisition prospects. That would remain essentially unchanged over the ensuing decades, save for the size of the business sought. Here are Buffett's criteria as laid out in 1982. We prefer 1. Large purchases, at least $5 million of after-tax earnings. 2. Demonstrated consistent earning power. Future projections are of little interest to us, nor are turnaround situations. 3. Businesses earning good returns on equity while employing little or no debt. 4. Management in place. We can't supply it. 5. Simple businesses. If there's lots of technology, we won't understand it. 6. An offering price. We don't want to waste our time or that of the seller by talking even preliminarily about a transaction when price is unknown. We will not engage in unfriendly transactions. We can promise complete confidentiality and a very fast answer as to possible interest, customarily within 5 minutes. Cash purchases are preferred, but we will consider the issue of stock when it can be done on the basis described in the previous section. Berkshire would, over time, find several businesses this way. 1983. Buffett's 1983 letter to Berkshire Hathaway shareholders opened with the report, almost in passing, that Berkshire had merged with the blue chip stamps, previously its 60% owned mini conglomerate. Buffett now had 2,900 owners to report to, up from 1,900. So he summarized the major business principles Berkshire followed pertaining to the manager-owner relationship. These principles would later be codified into Berkshire's Owner's Manual. The 13 principles, as laid out in the 1983 chairman's letter, were as follows. 1. Although our form is corporate, our attitude is partnership. Buffett and Munger view the company as a conduit through which our shareholders own the assets. 2. Directors are all major shareholders, and 4 out of 5 have over 50% of family net worth in Berkshire. We eat our own cooking. 3. The long-term goal is increase in intrinsic value per share, not the overall size of Berkshire. 4. Their preference is to own 100% of businesses, but they would also own parts of businesses and prefer those that generate cash and consistently earn above-average returns on capital. 5. Buffett and Munger look to economic performance, not accounting. They virtually ignore Berkshire's consolidated numbers. Despite this, they promise to provide the information they would want if they were a non-controlling shareholder. 6. Like above, they do not care about accounting consequences and want shareholders to know that some economic earnings don't show up, referring to the undistributed earnings of non-control investees. 7. They rarely use much debt and will reject interesting opportunities rather than over-leverage our balance sheet. 8. We will only do with your money what we would do with our own. 9. They measure performance as delivering at least $1 in market value for each $1 retained over a 5-year rolling basis. 10. Berkshire will only issue shares when we receive as much in business value as we give. 11. Buffett wanted existing new shareholders to know that they didn't engage in what Buffett called gin rummy capitalism. They would not sell good businesses regardless of price and would hang on to subpar ones if they promised to generate some cash and if relations with management were good. 12. They promised to be candid and present the business facts as if their positions were reversed and Buffett and Munger were the shareholders. 13. For competitive reasons, their candor could not extend to what they were buying, thinking of buying, or had bought in the open market. Nebraska Furniture Mart. Buffett's birthday present to himself in 1983 was a business. After long admiring Nebraska Furniture Mart and its founders, the Blumkin family, Buffett finally struck a deal to acquire 90% of the business on August 30, 1983. The business was located in his hometown of Omaha, Nebraska. The description of the family matriarch, Rose Blumkin, or Mrs. B, read almost like an obituary. Yet at 90 years old in 1983, she was still very much alive and active in the business. The business was her life, and she spent 7 days a week at the store. She had escaped Russia and labored to establish her family in America before saving $500. With that seed capital, she started her home furnishing store in Omaha. Over the ensuing years, the hard-working Mrs. B clashed with competitors who couldn't match her low prices. One fight ended up in a court battle, culminating in the judge buying carpet from her. Buffett admired Mrs. B's self-taught business sense, more impressive considering she was illiterate, which she turned around and instilled in her son Louis and then in his 3 sons, Ron, Irv, and Steve. When Berkshire took control, Nebraska Furniture Mart sold over $100 million annually out of one 200,000 square foot store. That was more than any other home furnishing store in the country and more than all Omaha competitors combined. The Nebraska Furniture Mart purchase, laid out on a 1.5-page contract, called for Berkshire to buy an 80% economic interest in the company. This math contrasts with the 90% majority interest quoted earlier because of a 10% option set aside, allowing key members of the management team to buy into the business. The 80% figure assumes this option is acted on. The rest would remain in the Blumkin family. What did Buffett see in Nebraska Furniture Mart? To start, it was in his hometown. Also, the store kept growing over time, and he could see that Mrs. B's attitude towards pricing was making life hard on her competitors. Nebraska Furniture Mart benefited from the classics of economies of scale. The more it sold, the lower its fixed overhead became as a percentage of revenues. The lower its relative costs, the lower it was willing to charge, on in a virtuous reinforcing cycle. Add in a huge selection of merchandise, and Nebraska Furniture Mart had a recipe both for saving its customers money and delivering superior returns to its owners. Once firmly entrenched, the business had a virtually impregnable moat that protected it from the onslaught of competition. Goodwill and its amortization, the rules and the realities. Berkshire's book value grew 32% that year to $975.83 per share. The 19-year record since Buffett took control in 1965 was 22.6% compounded annually. Buffett wanted shareholders to know loud and clear that they should not expect similar results in the future. Those who believe otherwise should pursue a career in sales but avoid one in mathematics. Buffett said he reported book value because it was a decent proxy for intrinsic business growth, the measurement that really counts. He also provided a comparative description. Book value tells what is put in the business, and intrinsic business value is what can be taken out, which is why it matters more. The explanation came because Buffett thought Berkshire's intrinsic value now exceeded its book value. This was due to Berkshire's venturing heavily into marketable securities, some of whose values were not reported at market, and its purchase of higher quality businesses above their book value, necessitating the inclusion of intangible accounts. Despite the accounting depressing book value and the higher quality businesses now part of the company, Berkshire's stock price rarely traded above book value. Sparing those not so well versed in accounting the gory details, Buffett only alluded to his appendix on goodwill. We will dig in. Over 4 pages, Buffett's appendix on goodwill provided those willing to spend the time with a valuable lesson on business. He was quick to point out that it was economic and accounting goodwill he was referring to, not customers' feelings of a company's product or service. Buffett explained that goodwill arises due to the difference between the purchase price of a business and the accounting value of its assets. Usually the purchase price is higher than the underlying assets, and, therefore, an entry on the asset side of the balance sheet must be made so that the transaction balances out. To make the lesson more concrete, Buffett used See's Candies as an example. When Blue Chip purchased See's in 1972 for $25 million, it had about $8 million of net tangible assets and earned about $2 million after tax, or 25% on its net tangible assets. The difference between the $25 million and $8 million was placed on the balance sheet as $17 million of goodwill. Prior to November 1970, this goodwill would simply remain on the balance sheet. After 1970, a charge to earnings was required for GAAP purposes, but not for tax purposes, to amortize the balance to zero. Most managements, Berkshire included, chose to do this over the maximum 40 years. Buffett viewed the amortization charge, which was included in expenses and therefore depressed reported earnings, as an artificial construct. He thought the economic reality of a See's-type business, one that earned much higher returns on its net tangible assets than other companies with similar resources, should be recognized by analysts and thus needed an accounting correction. The $425,000 charge to earnings that GAAP required Berkshire take every year, $17 million divided by 40 years, was not real and could be safely ignored. All transactions where the purchase price was greater than the underlying tangible assets required recognition and related amortization of goodwill, but not all those businesses were good. An eager management team on the hunt for a deal could overpay for a business and throw shareholders' money down the drain. Only a business with economic goodwill, one with a consumer franchise allowing the value of the product to the purchaser rather than its production costs to be the major determinant of a selling price, deserved such a treatment by analysts. Other such consumer franchises with true economic goodwill included those with a governmental advantage or monopoly, such as a TV station or the low-cost producer in an industry like Geico. To further complicate matters, the 1983 Berkshire merger with Blue Chip Stamps caused additional goodwill to be added to the equation for See's. Because Berkshire owned just 60% of Blue Chip prior to the merger, the purchase of the remaining 40%, via its increased ownership of Blue Chip, caused $28.4 million of additional goodwill to be added to the balance sheet, along with its own amortization schedule against earnings. The goodwill amortization for See's would increase to $1 million annually for the next 28 years, and then decline to $0.7 million for the following 12 years as the two pieces of amortization reached their accounting conclusion. Having two separate amortization schedules for two pieces of the same business was an accounting oddity without an easy solution. There was another lesson in this side note discussion of goodwill, and it was related to inflation. Buffett countered the traditional wisdom, long on tradition, short on wisdom, that tangible assets were the way to protect against inflation. Again, using See's as an example, he imagined the hypothetical doubling of prices and its effect on required investment in net tangible assets. With $8 million of combined net tangible assets, receivables, inventories, fixed assets, etc., a doubling of prices would cause the owner of See's to ante up an additional $8 million of capital to maintain the same unit volume. A business with the same earnings but requiring $18 million of capital, that is, a business earning a lower rate of return on its capital, would require $18 million from owners just to stand still. Clearly, the business with lower capital requirements would be worth more to its owners. Buffett wanted Berkshire's owners to realize the value in true economic goodwill because Berkshire would likely move in the direction of acquiring other businesses requiring similar treatment. The value of the goodwill asset on Berkshire's books totaled over $79 million at year-end 1983 and would likely continue to grow. Like the accounting for non-controlled businesses via the stock market, goodwill accounting told a story much different from the underlying economics, and it was the economics about which Berkshire cared most. Berkshire probably wouldn't find another business like See's, which was earning $13 million after tax on $20 million of net tangible assets, but a business even close would be worth paying up for. Buffett hinted at Berkshire's valuation in the discussion of value given versus value received as it related to using shares as currency in a transaction. He noted that the true cost of the blue chip merger was slightly higher because the market value of Berkshire's shares given up in the merger was less than their intrinsic business value. We can estimate the valuation used in the Berkshire Blue Chip Stamps merger. Using Berkshire's high and low share prices during the third quarter of 1983, when the merger would have taken place, values Berkshire between $900 million and $1.2 billion, see Table 4.31. The resultant average price-to-book value was 1.35 times. Sources of reported earnings. Due to the merger with Blue Chip in mid-1983, special care was needed in reading the earnings summary table in the chairman's letter. Since the ownership in Blue Chip increased from 60% to 100%, that change alone was enough to skew Berkshire's share of Blue Chip's and its subsidiaries' earnings up, all things being equal. Looking at the company-level results instead of the share attributable to Berkshire's ownership solved this issue. Leading off the table was insurance underwriting, whose losses had swollen on the heels of industry weakness. Berkshire's results were again worse than the industry average. The insurance group was profitable overall thanks only to its net investment income. More will be said about the insurance group below. Other notable entries in the table in 1983 were the Buffalo News, See's Candies, Blue Chip Stamps, Precision Steel, and a special distribution from Geico. The Buffalo News, long mired in a fight with its competitor, the Courier Express, won its long battle and was rewarded with soaring profits. The elimination of a competitor surely helped, but other factors also accounted for the success of the Buffalo News. First, a stable population in the Buffalo area made citizens highly interested in current events. Second, the Buffalo News had an earned reputation for editorial quality. Third, by design, it provided more news than other papers, about 50% compared to an average in the upper 30% range for competitors. Because of all these things, Sunday circulation, that was previously provided only by the competitor, increased from 314,000 to 376,000. This was even more impressive against a backdrop of little to no population growth. Never one to bask in the glow of good news, Buffett pointed out two extraordinary factors leading to the large swing in the profitability of the Buffalo News that year. Because of the substantial losses incurred in prior years, the business owed a subnormal amount of state income taxes. Additionally, there was a large drop in the cost of newsprint, a critical cost. Continuing to examine Table 4.32 from 1983, we can see that Blue Chip Stamps reported a loss compared to a sizable profit the year before. The 2 years weren't comparable because major assets were transferred in the merger. When the merger took place, Blue Chip subsidiaries became direct subsidiaries of Berkshire, and accounts not associated with any entity would have transferred too. It's unclear why Blue Chip remained as a reporting line and why it continued to lose money to the tune of $2 million per year. The footnotes did not mention it. Such a large swing in profitability, while notable, probably wasn't overly concerning given the circumstances. Precision Steel's profitability was depressed in 1982 due to weak industry factors and a business line venture into the measuring tool business that did not work out. In 1983, its profits rose threefold compared to that low base. Charlie Munger told Wesco shareholders and Berkshire's, as the report was shared with them, about the mistake. Munger replaced Louis Vincenti as chairman after Vincenti was forced to retire because of health reasons. Overall, Munger thought that Precision Steel would do well in 1984. See's Candies. Berkshire owned 100% of See's after the blue-chip Berkshire merger. While an exceptional business, See's faced its share of challenges. These were twofold: raw material costs rising faster than inflation and difficulty growing unit volume. Raw material costs were not a problem at the time, but they could become one given See's fanatical, Munger's word, adherence to quality. Buffett told shareholders See's would only buy the finest ingredients regardless of price. "We regard product quality as sacred," he said. The second problem, pounds sold per store, was mainly an industry phenomenon as per capita consumption of chocolate slowly declined. The increased prices at See's, a recession, and an already high market share probably all played a role. Poundage growth was hard to come by. Pounds sold declined 0.8% on a same-store basis during 1983. Cumulatively, volumes had declined 8% since 1979, although revenues were up due to a combination of price increases, related to and on top of inflation, and new stores. Focus was rightly placed on pounds sold per store. Cutting right to the key economic variable for See's and other retailers, Buffett told shareholders that "we regard the most important measure of retail trends to be units sold per store rather than dollar volume." More will be said in the discussion of 1984 results, which contain a history of revenues, operating profits, poundage, and number of stores for See's. Insurance. Bleak prospects and irrational competition dogged Berkshire's insurers and the industry. The 1982 revised figure for the industry combined ratio came in at 109.7%. The estimate for 1983, 111%. Berkshire's own combined ratio in 1983 was an atrocious 122.8%. See Table 4.33. Noting the delayed nature of the business, Buffett placed the blame on his shoulders. Prior to hiring Mike Goldberg to manage the insurance group, Buffett had made mistakes that finally materialized in 1983. Those mistakes included placing the wrong personnel in key operational positions, as well as direct and indirect mispricing of business. Buffett praised his managers, whom he said swam a good race against strong industry tides that year. He singled out National Indemnity's Roland Miller for delivering improved results, while competitors had opposite performance. He also identified Tom Rowley, who had joined Berkshire a year prior to run Continental Divide Insurance, a Colorado home state operation. Against the backdrop of a weak industry, results and underwriting losses came across all of Berkshire's insurance segments. Buffett was optimistic for the reinsurance segment. That segment had reported losses in each year dating back to 1975. Still, it had an ability to generate large float and, importantly, a way to monetize Berkshire's financial conservatism. The long period between buying reinsurance and when it might be needed meant a counterparty to a reinsurer would need to know the reinsurer would be around when the collection time came. Berkshire fit this mold perfectly. Its premier financial strength could be marketed as a differentiator. Putting this unparalleled financial strength to use, Berkshire entered the structured settlements business. In exchange for an upfront premium, which the insurer could invest, that converted the lump sum settlement into a stream of cash flows. This long-tail line of insurance paid out claims over many years. For some claimants dependent on receiving lifetime financial security, the viability of the insurer paying the claims is all important. Insurance. Geico. Berkshire's one-third interest in Geico was proportionally larger than Berkshire's other insurance interests combined. Objectively speaking, it was better, too. If proportionally divided based on ownership, Berkshire's share of Geico's premium volume would have been $270 million in 1983. Geico's combined ratio of 96% was by all accounts stellar. Such a financial result was reflected in the market value of the business. Berkshire's stake cost $47 million, had a market value of $398 million at year-end 1983. Buffett had nothing but admiration for the trio responsible, managers Jack Byrne and Bill Snyder, and Geico's investment manager, Lou Simpson. The summary of earnings table included a $21 million entry for a special Geico distribution. This was a de facto dividend from Geico accomplished via a tender offer that maintained Berkshire's ownership interest. Since it was treated as a dividend rather than a sale, Berkshire's got away with paying an effective income tax rate of just 6.9% compared to the 28% due if the transaction was recognized as a capital gain. Stock splits and stock activity. Calls to split Berkshire stock intensified as the price crossed the $1,000 mark for the first time. Buffett thought that splitting Berkshire stock was the wrong thing to do. Berkshire's communications practices were designed to cultivate a rational base of owners that sensibly considered the prospects of the underlying business and priced the stock accordingly. He preferred owners who cared about business results and not the ever-fluctuating price of a stock. A high stock price discouraged frequent trading. In a simple example, Buffett asked rhetorically whether an owner of one Berkshire share valued at $1,300, where the stock then traded, would be better off if Berkshire split 100 for one and he owned more shares equaling the same value. Buffett very clearly liked rational owners over ones preferring paper to value. It was not just the optical illusion of such artificially constructed stock splits that Buffett disliked. It also laid a cost on owners. If taken as a group, a company's owners were paying upwards of 2% of the market value of a business just for the privilege of moving in and out. Academia praised such liquidity, as did those who profited from the turnover, stockbrokers and exchanges, etc. Buffett disagreed. More shares would equal more fees, since those fees were often based on the number of shares traded. Splitting the stock would increase that cost, downgrade the quality of our shareholder population, and encourage a market price less consistently related to intrinsic business value. We see no offsetting advantages. As logical as Buffett's arguments were, and the clear disadvantages of a split, calls for splitting Berkshire stock would continue. 1984. Continuing his practice of leading with the bad news first, Buffett opened his 1984 chairman's letter to shareholders saying that the nearly $153 million gain in net worth during the year was mediocre. Such an amount of money was, and still is, quite a large sum. The problem was it represented just 13.6% increase on the prior year's book value. This was far short of the 22.1% compounded annual gain over the previous 20 years. Economic gains must be evaluated by comparison with the capital that produces them, wrote Buffett. Berkshire Hathaway's equity capital crossed the $1 billion threshold during 1983. This was partly due to the merger with Blue Chip Stamps. Maintaining high rates of return on that capital would get more difficult every year. To achieve even a 15% annual gain would require adding a $3.9 billion to book value over the ensuing decade, assuming no dividends were paid. Such a rate of return seemed modest, but it represented a doubling every 5 years. Not an easy feat for any business, let alone one Berkshire's size. Accomplishing high rates of growth on Berkshire's equity base would require a few big ideas. Small ones just won't do. Rather than try to lay out a detailed plan of action, Buffett continually searched and waited for ideas to come. The question was, when? Our experience has been that they pop up occasionally, he said. How's that for a strategic plan? Buffett was not being curt, just realistic. Rather than try to force ideas to happen and therefore potentially make a mistake, patience would be the default course of action. Later in the letter, in discussing Berkshire's equity portfolio, Buffett commented, "We find doing nothing the most difficult task of all." Sources of reported earnings. Berkshire's operating results were best viewed on a company-level pre-tax basis, considering the merger with Blue Chip Stamps the prior year. This view also stripped out the goodwill amortization charges required by accounting standards and placed them on a single line. Front and center was insurance underwriting, discussed in more detail later, again posting a miserable result. Weak industry conditions, coupled with self-inflicted wounds, were causing the red ink to continue flowing in Berkshire's underwriting. Net investment income had saved the day to bring the insurance group out of the red. Related to insurance, the special Geico distribution reported in 1983 again garnered attention in 1984. Though the distribution was technically accomplished via a share repurchase, it had functioned more like a dividend since Berkshire's ownership interest remained unchanged. This is how Berkshire had viewed it, as had the Omaha office of its auditor, Peat, Marwick, Mitchell & Company. However, in 1984, the New York office of the auditor reversed course. It said the transaction should be viewed as a repurchase, with some of the proceeds being recorded against, that is, reducing, the carrying value of the stock on Berkshire's books. There were no tax consequences and the economics remained unchanged, but the accounting did. Berkshire expressly disagreed with the auditor's conclusion but went along with it rather than incur a qualified opinion of the financial statements. The Geico special distribution might have gone unrevised had it not been for a very similar transaction with General Foods in 1984. With General Foods, the share repurchases had been over time, whereas with Geico it was a one-time event. The total amount received from General Foods was $21.8 million, and Berkshire's ownership interest remained at exactly 8.75%. The difference between the reported amount of $8.1 million and the total amount received was recorded as a capital gain. Buffett was a fan of the type of share repurchases conducted by Geico, General Foods, and others, since the shares were selling below intrinsic value at the time of the repurchase. Share repurchases below intrinsic value increased underlying value to continuing shareholders, but also shrunk the size of the business that the manager operated. Managers not focused on their owners, shareholders, would seldom conduct such transactions or would blindly repurchase shares without considering valuation. These managers were short-sighted, thought Buffett. The obvious reward for conducting value-add share repurchases was a gain in per-share intrinsic value for continuing shareholders. The less obvious and longer-term reward was a share price that reflected the sound management of the company. Buffett preferred to partner with shareholder-conscious managers. Nebraska Furniture Mart. Nebraska Furniture Mart was still earning an excellent return on capital for shareholders, but it provided just as much value to customers through lower prices for high-quality merchandise. How did it do this? In short, it sold a lot of merchandise through one location and relentlessly controlled expenses. Nebraska Furniture Mart operated on a gross profit margin in the mid-20% range. By comparison, Levitt's Furniture, the industry leader at the time, had a gross profit margin of 44.4%. Levitt's operating expenses, all the other costs that go into running a store such as payroll, advertising, and upkeep of the buildings, amounted to 35.6% compared to Nebraska Furniture Mart's cost of 16.5%. Buffett estimated that Nebraska Furniture Mart saved its customers over $30 million each year due to its lean operating structure. All of this is that much more impressive since Buffett considered the Levitt's operation well managed. What was the secret? Buffett compared the Blumkin family to Ben Franklin and Horatio Alger and said they applied themselves with enthusiasm and energy, stayed within their circle of competence, and always acted honestly. Buffett saw the best of himself and Berkshire in the Blumkin family. See's Candies. If Nebraska Furniture Mart earned Buffett's high praise, See's really got his blood pumping. According to the 1984 annual report, identifiable assets for See's averaged $63 million, and after-tax profits of $13.4 million equated to a return of 21%. On tangible assets of $28.2 million, the return was even higher, 47%. The actual economic return of See's was even better considering not all aspects of the business were part of the accounting. The report only listed tangible assets. It did not account for the spontaneous liabilities associated with conducting business, such as accounts payable. Since others provided part of the capital to operate the business, the company did not need to fund it. Given this assumption and the use of a seasonal line of credit to fund short-term inventory, the returns on net tangible assets, or equity, were likely well above 100% for the candy company. Still, the business wasn't perfect. The boxed chocolate industry suffered from marginal profitability and slow growth. The latter ailment also beset See's. Same-store sales fell 1.1% in 1984, though total poundage was up 0.6% because of store growth. If pounds sold only grew through physical store expansion, the per-pound selling cost would, by definition, increase, a result that could not go on forever. Despite these problems, See's had clear pricing power. Over the 13 years that Berkshire, via Blue Chip, had owned See's, it was able to increase its per-pound selling price by 9.5% per year and its per-pound profits by 13%. Over that same period, the price level increased, on average, 7.9% per year. Given the success of See's against the backdrop of weak industry conditions, the natural question is how? Buffett said it was the company's relentless focus on quality. Competitors, he said in his letter, would add preservatives or freeze the finished product in order to smooth the production cycle and thereby lower unit costs. We reject such techniques. See's was willing to put up with the headaches that came with trying to produce and deliver product in a short window of time during the holiday season using nothing but the freshest ingredients. The month prior to Christmas accounted for 40% of the volume and 75% of the profit for the year. Easter and Valentine's Day also did well, but the remainder of the year was spent treading water. The success of See's seemed to stem from the company's willingness to think and act long-term and to accept short-term pain in exchange for long-term profitability. It focused on the customer and built its business around it, rather than trying to smooth out operations and manage the business from an accounting viewpoint first. See's was an excellent cash cow for Berkshire, one that would continue to deliver profits to Omaha for redeployment into the ever-growing Berkshire empire. The Buffalo News. The Buffalo News delivered a $27.3 million pre-tax profit to Berkshire in 1984. Compared to what it earned in 1983, this represented an almost $8 million or 41% increase. Competition, or the lack thereof, now that the Courier Express folded, was a major contributor to the success of the Buffalo News. So too were its customer-centric policies, which were, somewhat unexpectedly at first glance, very similar to See's. Coming out on top in a winner-takes-all contest helped tremendously, but the paper deserved its success. Like See's, it delivered, no pun intended, more value to its customers than the competition. Buffett summed up its strategy this way: since high standards are not imposed by the marketplace, management must impose its own. This was no different than the self-imposed quality standards at See's, which paid for the highest quality ingredients almost regardless of cost. The newspaper's news whole, meaning its ratio of news to total printed pages, was 50.9% in 1984. This compared to more typical levels between 35% to 40% at similar papers. The News was willing to incur the additional cost of newsprint paper as well as more newsroom staff than competitors. It was rewarded with higher readership, which was in turn valued by advertisers. Two other related factors played an important role in the paper's success. For one, the readership of the paper was concentrated into the Buffalo, New York area. This translated into high value to advertisers. Paid advertising by a grocery store that was viewed by a reader 100 miles away, for example, would be wasted. In fact, the term used for such an occurrence was wasted circulation. The penetration ratio was another success factor. Since the Buffalo News reached a very high percentage of Buffalo residents, advertisers wanting to reach those subscribers could easily do so. The paper's penetration ratio and the relevance of readership to potential advertisers can be thought of visually as two overlapping circles. The wider the circles, the greater the penetration ratio, the more overlap between the two circles, the more shared customers between the paper and its paid advertisers. Insurance. Berkshire's underwriting loss in 1984 resulted in what Buffett called a humbling combined ratio of 136%. See Table 4.36. The industry, by comparison, wrote at a ratio of 117.7% and was not increasing premiums fast enough to make up for increases in underlying costs. This was the third year in a row that Berkshire's experience was worse than the industry. The poor industry performance and even poorer Berkshire results did not dissuade Buffett. That year, Berkshire added capital to its reinsurance unit, Columbia Insurance Company, to continue growing the structured settlement business. He expected a lot of competition but satisfactory returns. Berkshire would continue to use its financial strength to its advantage and only write business that made sense. The financial strength was hard to see precisely on Berkshire's consolidated financials. Prior to 1981, Berkshire had presented separate condensed group financial statements that provided some additional detail on balance sheet items such as the investment portfolio, plant and equipment, lost liabilities, unearned premiums, and other items. From these, it was clear exactly how much shareholders' equity was attributable to the insurance group. Detail on the income statement items largely remained in subsequent reports, but a holistic balance sheet was not provided. Even without the specific detail, it was clear Berkshire remained heavily weighted toward insurance. Making some assumptions, we can estimate that Berkshire's written volume in 1984 would have represented just 17% of equity capital, a ratio far below the capacity of an insurer. and an indication as to how much Buffett and his managers had put the brakes on operations during the period of weak pricing. Geico dwarfed Berkshire's insurance group. Looking through to Berkshire's share of Geico's premiums, Berkshire owned 36% of Geico at this time. Berkshire's share of its premium volume in 1984 was $320 million. Buffett praised its managers, Jack Byrne, Bill Snyder, and Lou Simpson, for creating and sustaining a major sustainable competitive advantage in an industry where such an advantage was almost unheard of. He heaped additional praise on Simpson, who has the rare combination of temperamental and intellectual characteristics that produce outstanding long-term investment performance. As good as Geico was, and it was, and is, a very good business, its advantage stopped at its core business. It was natural for a management team to build on its success and expand into adjacent areas. Yet attempts to do so had largely failed, and this refocused Geico's management back on the core automobile insurance business. Errors in loss reserving. The business lesson for 1984 was on a topic central to insurance, Berkshire's largest and most important division. It also shed some light onto what created the large underwriting losses of the last several years and why management couldn't immediately stem the red ink. Central to the insurance business are estimates of its future losses. Because they are just that, estimates, they are subject to error at best. At worst, they can lead to lying and fraud. In a normal business, profits or losses are known fairly rapidly. A box of chocolates that cost $4 to produce and sell, and that was sold for $5, would clearly generate a profit of $1. An insurer, on the other hand, takes its revenues first, whether earned or unearned, and must estimate up front what its future costs will be over the life of the insurance contract. It not only doesn't know how much it will cost, but it might not even know when that cost will come. In short tail lines of insurance, like automobile insurance, policies are written for 6 months to a year, and claims are paid out accordingly. There may be a slight delay in when a claim happens and when it is reported. These are referred to as incurred but not reported losses, or IBNR. But generally, the insurer knows very quickly. In long-tail lines of business, such as with Berkshire's reinsurance or specialty units, claims might take years or even decades to come to light. Results from year to year understandably move around, though provided the insurer sets premiums at a level that reflects its costs over time, it will ultimately report a profit. Insurers track their guesses for future profitability of the business they write in what are known as loss development tables. As time goes on and claims are paid out, the true profitability emerges. This can take some time and the road can be bumpy. Buffett's 1984 letter contained a table of the 5 years ended in 1984 that listed underwriting results, both as originally reported and as corrected 1 year later. The table showed 1 year of favorable loss development, 1980, followed by 3 years of results that deteriorated in hindsight. The question mark left in the table suggested the loss in 1984 was anyone's guess. Berkshire tried to be conservative in its underwriting, but the track record suggested results would only worsen. Not only was Berkshire suffering from current industry weakness, but the business it wrote in years past was haunting it. Accounting and insurance reporting conventions dictate that as loss estimates for prior years worsen, revisions are included with the current year's underwriting results. For example, consider a $100 policy written in year 1 with an expected profit of $5. Now consider that in the next year that profit was revised to a loss of $5. The $5 profit would remain in the first year, the insurer wouldn't restate its earnings, but instead a $10 loss would be booked to losses in year 2. It was simply the nature of the business and its accounting conventions made for a bumpy ride. To add insult to injury, an optimistic insurer who overestimated profit paid more tax than would have otherwise been necessary. These overpayments eventually correct themselves, but there was no interest received on the amount overpaid. Buffett was more than embarrassed by the missed estimates. He felt that he had let shareholders down and said so in his letter. He wrote that his error in reporting is a source of particular chagrin to me because, 1. I like for you to be able to count on what I say. 2. Our insurance managers and I undoubtedly acted with less urgency than we would have had we understood the full extent of our losses. Revisions in 1984 to prior year estimates totaled $17.8 million, or 12.7% of premiums earned that year. These revisions stemmed primarily from the reinsurance segment, which itself was subject to the estimates provided by the primary insurers whose businesses they took on. Most of the remainder of the change in loss reserves was due to workers' compensation, which was another long-tail type of insurance whose ultimate profitability took time to materialize. The insurance business had another quirk which made trust and track records important. The revisionary type scenario above is simply a part of the business. Any 1 year or a few years might be poor, so an insurer with a long-term track record of an overly optimistic reserving would find itself nearly out of business. In such a case, its management could forestall that day of reckoning by continuing to write new business, even at a rate that would ensure a loss. Since premiums generate cash up front to pay claims later, unscrupulous managements could bring the ship right up to the edge of a cliff before falling straight off. As Buffett put it, insurance is different. You can be broke, but flush. Buffett openly worried about the effect of these Walking Dead type companies and their effect on Berkshire. Not only would Berkshire suffer once as a competitor when those companies drove down premium rates, but again via state guarantee type arrangements which bailed out policyholders of failed firms. He urged regulators to more strictly police the industry to mitigate the damage from such events. Washington Public Power Supply System. From late 1983 to mid-1984, Berkshire's insurance group purchased large quantities of bonds in Washington Public Power Supply System, WPPSS. Specifically, Berkshire's $139 million investment was in Projects 1, 2, and 3. This distinction was important as Projects 4 and 5 were abandoned and $2.2 billion of related bonds languished in default. The default was what presented the opportunity to Berkshire. There was acknowledged risk that the investment could prove unsatisfactory, but both Buffett and Charlie Munger judged the risk appropriate. The default issues with Projects 4 and 5 meant they could pay a lower price and therefore receive a higher yield for the investment in Projects 1, 2, and 3 compared to other bonds available at the time. Those projects also had important differences in credit quality. Berkshire's $139 million invested earned $22.7 million after tax, equating to a 16.3% unleveraged return. He said a similar earning business might fetch between $250 million and $300 million. The description of the investment read like that of an equity investment, but the WPPSS investment was in its bonds, an important distinction. Buffett wrote that a bond as a business mindset may strike you as a bit quirky. However, we believe that many staggering errors by investors could have been avoided if they had viewed bond investment with a businessman's perspective. Focusing on the underlying business, the ultimate source of interest payments to bondholders, and any residual earnings accruing to equity holders led to more rational thinking. The bond as a business investment was a large one. Just like Berkshire's equity investments, it did not make inconsequential investments in attractive bond investments. The $139 million investment represented 12% of Berkshire's 1984 average equity and 7% of its average assets. If these WPPSS bonds defaulted like Projects 4 and 5, Berkshire would take a large hit. Buffett and Munger were willing to make such intelligent but with some chance of looking like an idiot investments because they thought the odds were in their favor. Controlling 47% of Berkshire's stock between them also helped. Berkshire's financial strength played a role in allowing it to take calculated risk in the pursuit of superior returns. In writing far less business than it otherwise was capable, financial strength often penalized Berkshire's results. In cases such as WPPSS, Berkshire could make the investment without much fear of backlash from insurance regulators because it possessed a large margin of safety in its capital position. Other insurers often wrote as much as their balance sheets would allow. This handicapped them since their capital position was not strong enough to withstand a big error, no matter how attractive an investment opportunity might appear when analyzed on the basis of probabilities. The result was that these insurers had to invest much more conservatively, hurting their long-term investment results. The WPPSS bonds were an attractive security in an asset class that did not generally interest Berkshire. Even though inflation had diminished substantially, it was always lurking just around the corner. Owners of businesses would be hurt by inflation, to be sure, but bondholders would be in a far worse position that could potentially wipe out their advantageous capital position. Mutual savings. Charlie Munger's chairman's letter to Wesco shareholders, again included in the Berkshire Annual Report, provided readers with an education on banking. His comments on the thrift, savings and loan industry contrasted mutual savings' conservative operating practices to a world where competitors were increasingly taking on significant risks. For Berkshire shareholders who had become familiar with the banking business via their investment in the now divested Illinois National Bank, mutual savings would seem familiar. Munger said mutual savings had three major characteristics. 1. Maintained a high level of shareholders' equity compared to total assets and savings account liabilities. 2. Held a large proportion of cash and marketable securities to offset those liabilities. 3. Had a low-yielding mortgage portfolio, primarily a result of its branch divestiture in 1980. Though the average yield on its mortgage portfolio was below the bank's cost of funds paid to depositors, it had remained profitable every year due to its large marketable securities portfolio. Just like Berkshire's insurance group, mutual savings was waiting for the right terms and conditions on which to do additional business. The summary data on mutual savings provided in the Berkshire Annual Report illustrated its conservatism. Its assets were funded by a stable source of deposits and backed by a large amount of shareholders' equity and liquid resources. Banking then and now, almost by definition, involved borrowing short and lending long. A bank took its depositors' money, most of which was usually on demand, and lent it on terms to borrowers to purchase homes, finance businesses, and for other needs. The mismatch between the typically lower short-term interest rates paid to depositors and the typically higher rates received from borrowers, the spread, is how a bank makes money. Such an arrangement carried a small risk that interest rates would increase rapidly and cause the cost of money, the interest rate paid, to exceed the rate at which it was lent out. Savings and loan institutions, also known as thrifts, such as mutual savings, benefited from quasi-governmental protections over other traditional banking operations. These protections gave them a slight edge over traditional banks and reduced competition. When regulations changed allowing free competition for deposits, i.e. no limit on interest rates paid, some banks, and more acutely thrifts, found themselves paying higher rates to depositors than those earned from lending, a disastrous backward result. Mutual savings was staying far away from more lenient lending practices. In addition to the cost of money, interest paid to depositors, a banking institution also faced costs from losses on bad loans. Just like the insurance business, those losses can take time, sometimes years, to materialize. Munger described a sort of Gresham's law where bad loan practices drives out good, and where some institutions attempting to cover rising interest costs began lending to increasingly riskier borrowers. Munger knew it was only a matter of time before trouble arose. He decried the actions of competitors not just because it hurt mutual savings, but because competitors were profiting from using the government's credit. Since depositors benefited from government guarantees on their savings if the institution failed, they were indifferent to how their money was used. Losses above a bank's equity capital would ultimately accrue, in the case of the thrift industry, to the Federal Savings and Loan Insurance Corporation, FSLIC, the government arm that insured their deposits. Munger used an automobile insurance example to illustrate mutual savings' position. Mutual savings was like the sober and careful driver who drove few miles but had to pay an insurance premium based on the risks attributed of a larger pool of drivers. Those other drivers drove a high number of miles and led other than sober lives. Through the premiums it paid for deposit insurance, mutual savings was subsidizing the rest of the industry. Munger praised Federal Home Loan Bank Board Chairman Edward R. Gray for taking on the unenviable task of reining in the risky behaviors of less conservative industry participants. Mutual savings' unwillingness to participate in risky lending practices had caused a decline in business, but there was some good news. In accounting terms, mutual savings' loan portfolio declined by 11% to $95 million. However, during the year it agreed to forward purchase a $30 million pool of government-guaranteed mortgages that yield 15% on its $19 million purchase price. In coming years, the loan portfolio yield of mutual savings would start covering its funding cost as these higher-yielding mortgages became part of the mix. The commitment to purchase these mortgages in the future was the economic equivalent of making a loan during 1984. Munger told Westco shareholders that in substance its mortgage portfolio had increased by 7%. Dividend policy. Buffett repeatedly told shareholders why he disliked dividends. He used a long section in his 1984 chairman's letter to illustrate why in detail. Buffett considered capital allocation crucial and thought managers and owners should think hard about the circumstances under which earnings should be retained and under which they should be distributed. He did not like the fixed percentage of earnings dividend payout ratios that other managers blindly targeted without any thought to alternative uses for that capital. Instead, opportunity costs should be front of mind and attention paid to economic reality. The key was getting managers to think like owners and compare all investment opportunities, even if they lay outside the manager's own business. Some managers displayed contradictory behavior. On the other hand, they might tell an under-earning subsidiary to give the parent company its earnings, which were then reinvested into a higher-earning one, a rational decision on its own. The problem was those managers would then turn around and have earnings retained at the parent level, even though there were higher-earning opportunities elsewhere. The other consideration relating to dividend policy was inflation. In an inflationary environment, a capital-intensive business required investment to maintain its unit volume. Even if a business showed a bottom-line profit, the economic reality could be such that a portion or even 100% of those profits weren't economically real. A business that paid out in dividends more than its economic earnings would face oblivion as its competitive position and/or financial strength eroded. As an example, recall the textile companies from the first part of this book. A business that faced higher costs due to inflation and did not have the capital on hand to pay was no different than the textile companies in the early part of the 20th century that paid out dividends when they should have used that cash to replenish depreciated equipment. Those textile companies eventually suffered mightily, and so too would the owner of a capital-intensive business operating in an inflationary environment. Buffett said Berkshire's own dividend policy would be to retain all earnings. Berkshire met the test of creating $1 of market value for every dollar retained, and would have done shareholders a disservice by instituting a dividend. Looking forward, he even teased a future use of those retained earnings. He thought the insurance industry was set for a rebound in 1985, and a financially strong competitor like Berkshire stood to do well with available cash to invest. Buffett's 1984 letter concluded with two advertisements. One was the same business wanted advertisement as prior letters looking for acquisition candidates. The other was an invitation for his shareholder partners to the annual meeting in Omaha, where a purchase at Nebraska Furniture Mart could save far more than enough to pay for your trip. After 20 years under Buffett's leadership, Berkshire had become a far more diversified and profitable business, and one where shareholders might have, dare it be said, fun. Decade in review. The changes that occurred during Warren Buffett's second decade at the helm of Berkshire Hathaway can be summed up in two words: size and scope. Its equity capital grew by a factor of more than 14, from $88.2 million to almost $1.3 billion. Its insurance operations grew both organically and from investments in multiple home state operations, workers' compensation, and reinsurance. Berkshire grew its stable of wholly owned businesses into diverse industries such as steel products and newspapers, and through blue chip stamps and its marketable securities portfolio into many diverse enterprises. The question of just where all that additional equity capital came from can be summed up in a few categories. Table 4.40 illustrates the degree to which Berkshire's investment portfolio became the driver of growth. Berkshire took advantage of chances to buy businesses outright, but found more opportunity to buy pieces of good businesses via investments in their publicly traded stock. Accounting considerations were relegated to the background in favor of economic reality, though pains were taken to reconcile the two in communications with shareholders. Even Berkshire's largest division, insurance, found itself shadowed by the investment portfolio, which, to be fair, funded a large portion of it. By the end of the decade, Berkshire's share of GEICO's premium volume eclipsed that of its own group of insurance businesses. The mergers divestitures net row aggregates three distinct and important transactions. 1. In 1977, Berkshire merged with Diversified Retailing, which resulted in a net of about $9 million added to Berkshire's equity capital. 2. In late 1980, Berkshire divested of the Illinois National Bank and Trust. That transaction, effectively accomplished via a treasury stock transaction, reduced Berkshire's equity by approximately $29 million. 3. In 1983, Berkshire merged with Blue Chip Stamps, adding a net of about $154 million to Berkshire's equity. The results for shareholders that book value per share increased from $90.02 at year-end 1974 to $1,108.77 year-end 1984, a compounded annual rate of return of 28.5%. Importantly, this result was on a per-share basis. There had been some dilution to shareholders as shares outstanding grew from 980,000 to 1,147,000, 1.6% per annum, over the preceding 10 years, but by and large, Buffett had not enlarged his managerial kingdom at the expense of shareholders. On the contrary, during the diversified Illinois National and Blue Chip transactions, he went out of his way to ensure fairness to his shareholder partners. A powerful tailwind pushed Berkshire's stock price upward over the decade. The market rewarded the high growth rate of underlying intrinsic value, proxied by the change in book value, with an increasingly higher price-to-book value. Steadfast investors owning Berkshire for the entire decade were rewarded with a return of 40% per year. The fuel for this remarkable growth was largely Berkshire's insurance group. Growth over the preceding decade was impressive, even after pulling back toward the end of the decade because of industry weakness. Yet the financials understated Berkshire's massive push into insurance, as its 36% investment in Geico was responsible for an additional $336 million in premiums on a look-through basis. Berkshire's investment portfolio grew steadily, funded through funds generated via float, retained earnings, and additional capital contributed to the insurance companies. The composition of the portfolio at the beginning and end of this decade highlights Buffett's propensity for holding companies for a long time and his increasing tendency to concentrate bets. Of the $1.3 billion common stock portfolio at year-end 1984, almost one-third was Geico. The top four positions, Geico, General Foods, Exxon, and the Washington Post, represented 75% of the entire portfolio in 1984. The top four positions in 1974 represented 48% of the portfolio. The Washington Post, which represented a quarter of the portfolio in 1974, was the only investment in the top four that extended over the entire decade and had dropped to fourth place. Berkshire was much more concentrated at the end of the decade than at the beginning. Buffett was comfortable with this level of investment concentration because he had conviction and because Berkshire's financial strength allowed for it. The float generated by the insurance group was technically the result of the assumption of liabilities to finance additional asset purchases. But these liabilities had no due date and could be controlled for the most part by writing additional business. Berkshire's financial debt at year-end 1984 was low, and at $127 million, it represented just 10% of shareholders' equity. What's more, it consisted of long-term notes with varying maturities stretching over 20 years into the future. Berkshire's diverse sources of earnings power also contributed to its ability and willingness to concentrate its investment portfolio. Berkshire could count on cash coming in the door from the recently acquired Nebraska Furniture Mart, its now profitable Buffalo News, See's Candies, and the various businesses under the Wesco umbrella. Pre-tax operating earnings from its non-insurance businesses after deducting interest, but excluding amortization of goodwill and the discretionary shareholder-designated contributions, amounted to $66 million in 1984. This figure was also outside of the $69 million of pre-tax net investment income, largely attributable to the insurance segment. The Berkshire that emerged from Buffett's 2 decades of polishing, painting, and refining was radically changed from the money-losing textile operation he inherited in 1965. Shareholders owned, through Berkshire, investments in many diverse business operations, some in whole, some in part. They could look forward to communications that did not just report troubles, but opportunities. Berkshire, going into Buffett's 3rd decade of control, had prospects. Lessons, 1975 to 1984. 1. Even good businesses can experience challenges. Buffett and Munger faced many problems from the insurance group during the decade and oversaw massive underwriting losses toward the end of it. Even See's Candies, a wonderful business by all accounts, had its problems dealing with certain input costs. 2. Competition can be brutal and sometimes irrational. The actions of competitors in the insurance industry and their lack of understanding about the true long-term cost of doing business caused industry premiums to be inadequate. Not only did those specific competitors suffer, but others, including Berkshire, suffered as well. In a completely different business, the Buffalo News, the paper almost failed because of competition. There was no room for two competing papers, but the competitor did not go down without a protracted legal fight. 3. Inflation wreaks havoc on all businesses, and especially those with high capital requirements. It causes some earnings to be illusory, or, to use Buffett's words, ersatz or restricted. It forces capital to be reinvested in the business just to stand still and maintain unit volume. Sometimes inflation can be other than just monetary, such as the social inflation in jury awards. 4. Mergers, divestitures are okay if done at an appropriate valuation. What truly matters to shareholders is not the size of a company, but its growth in intrinsic value per share. Managers can destroy value by issuing undervalued shares to complete acquisitions. 5. Economics versus accounting. Owner's wealth is built over the long run by focusing on economic realities. Accounting is only the starting point of the analysis, and it oftentimes obscures rather than illuminates, according to Buffett. In Berkshire's case, this was an acute problem since significant value resided in the look-through earnings of its investees via its marketable securities portfolio. Chapter 6, 1985 to 1989. Introduction. Focusing just on the third decade of Warren Buffett's control of Berkshire Hathaway, we find a company hitting its stride. Up until 1985, Buffett and his business partner, Berkshire Vice Chairman Charlie Munger, had something of a weight around their ankles in the form of the company's former identity, namely the textile division. Even with this anchor, they achieved an incredible amount in the prior decade, reallocating capital to more profitable businesses. In 1985, Berkshire freed itself from its past by closing the textile division. This really allowed the wind to fill its sails. The magnitude of the changes Berkshire Hathaway experienced during the 1985-1994 decade were incredible. Revenues grew from $729 million in 1984 to $3.8 billion at year-end 1994. Shareholders' equity, while somewhat augmented by issuing stock, increased almost tenfold to $11.9 billion and resulted in a similar magnitude change in per-share book value. Many capital allocation decisions created that change. They fell into two broad categories: allocation of capital into new wholly owned subsidiaries and the purchase of part ownership interests in very good public companies. Berkshire acquired several simple yet highly profitable new businesses during this decade. Major additions included Scott Fetzer, a mini conglomerate whose largest divisions, World Book Encyclopedias and Kirby Vacuum Cleaners, were well known to the general public. Unexpectedly, Berkshire also moved into the shoe industry in a big way. Under the direction of expert capital allocators Buffett and Munger, Berkshire acquired large stakes in several well-known public companies and in some cases joined the boards. The company issued and redeemed a significant amount of debt during this time and also issued shares in connection with a sizable acquisition. The 1985-1994 decade was one where Berkshire Hathaway moved swiftly to implement its leaders' understanding of good businesses, and in particular the potential for value creation in its insurance operations. 1985. Having labored through some difficult years in the past, the year 1985 was a good one for Berkshire Hathaway, not just because of the record 48.2% gain in net worth. Its insurance businesses, though still struggling with underwriting losses, were moving in the right direction, as was the industry, and the insurance business was bolstered by new volume acquired via a quota share arrangement. Berkshire also received a windfall from its General Foods investment when that company was taken over in a leveraged buyout. Not one to bask in glory no matter how richly deserved, Buffett tempered the results with some history and math. Increasing Berkshire's net worth by 15% per annum over the decade would require Berkshire to earn profits of $5.7 billion. Only 15 companies in the U.S. managed such a feat over the preceding decade. Although our scope is not circumscribed by history, structure, or concept, we will also need a full measure of good fortune to average our hoped-for 15%. Tempering expectations was classic Buffett, but it was especially appropriate in 1985. Berkshire stock usually sold at a slight discount to intrinsic value, but recently it had started trading at a premium. This would be a boon to existing shareholders, but not new ones. For their results to match Berkshire's underlying results, that premium would have to remain. If it shrunk to its historical below intrinsic value level, then good business results at Berkshire could translate into less than satisfactory results for those new shareholders. Buffett would continue to subtly influence the share price via Berkshire's candid disclosures. Shutdown of the textile business. Reflecting on the past, Buffett considered buying control of Berkshire a colossal mistake. It led to his original partnership investors, himself included, to give up a fraction of the ownership of much better businesses acquired through Berkshire rather than buy them through another entity. And that was to say nothing of the now 2 decades of frustration watching an industry decline into oblivion. As Buffett put it, the unpleasant job of shuttering the remnants of Berkshire's past was largely completed by July 1985. He was sympathetic to the managers and employees associated with the textile operations, but in the end, economics won out. Berkshire couldn't remain in a competitively disadvantaged business that required ongoing capital investment at subpar returns. The figures were unambiguous. Over the 9 years prior to Buffett's involvement, Berkshire Hathaway was entirely engaged in textile manufacturing. During that time, it lost $10 million on a total of $530 million of revenues. By comparison, See's Candies earned $2 million on revenue of $31 million the first year it was purchased. Although textiles did deliver some profits in the 1960s, they were not adequate compared to the capital required to produce them. As the years wore on, the division's profits only worsened, and as the competitive disadvantages accrued, it became obvious that the business was not viable. Buffett praised the division managers Ken Chase and Gary Morrison as resourceful, energetic, and imaginative in their efforts to operate the textile group profitably. He even put those managers on the same level as those running a gem like See's. The textile business failed not because of them, but despite their monumental efforts. They were simply dealt a bad hand. Berkshire's employees and their unions were praised too, for accepting below-average wages and understanding the economic position of their employer. Even after the decision to liquidate the mills was made, both management and the employee base performed superbly, said Buffett. Buffett summed up his predicament in allowing the mills to operate at subpar levels for so long. I won't close down businesses of subnormal profitability merely to add a fraction of a point to our corporate rate of return. However, I also feel it inappropriate for even an exceptionally profitable company to fund an operation once it appears to have unending losses in prospects. Adam Smith would disagree with my first proposition, and Karl Marx would disagree with my second. The middle ground is the only position that leaves me comfortable. His statement reflected the owner-related business principle of not participating in gin rummy capitalism, contained at the beginning of the annual report. Berkshire would buy for keeps, and as a rule would not sell underperforming units in an effort to redeploy the capital into higher-earning assets. Buffett communicated his position to shareholders in the past by reminding them that Berkshire's textile workers were largely older and possessed almost no skills outside of textile manufacturing. Many were also foreign-born and spoke very little English and would have been severely hurt by closure of the mills. Many were hurt with the 1985 mill closure, but Buffett could at least point to efforts to cushion the blow. The problem was that the textile business, especially in New England, was not economically viable. The liquidation of the mill's assets told the story. See Table 5.4. Equipment of enormous importance in prior years was rendered economically useless over time by the onslaught of competitive pressures. In the end, it was sold for almost nothing. A commodity-type business like Berkshire's textile operations faced illusory investment options. Each opportunity for investment, say a new machine that promised to reduce costs, was rational from the standpoint of the individual firm. But when all companies in the industry made such decisions, the advantages disappeared. Buffett summed it up as akin to standing on one's tiptoes watching a parade. It helps for a fleeting moment, until everyone else does the same. Then you see no better and have achy legs. Considering the situation of Berkshire's textile operations in 1985, it was quite clear that industry was, at best, difficult. Yet some textile mills remained. Burlington Industries was the largest U.S. textile company from the time Buffett took over Berkshire until it closed the division. In 1964, Burlington had revenue of $1.2 billion compared to Berkshire's $50 million. In the 21 years that followed, Burlington made $3 billion of capital expenditures. Revenues in 1985 were just $2.8 billion. It was a devastating result that led Burlington's share price to essentially remain unchanged at $60 over that period. Considering the Consumer Price Index had risen threefold over that time, Burlington shareholders who stayed on for the ride saw their real purchasing power shrink commensurately. Berkshire shareholders would surely have faced the same agonizing decline if it weren't for the arrival of Warren Buffett and his capital allocation skills. Instead of oblivion, Berkshire shareholders saw a newcomer harness the textile business's dying breaths to create a profitable enterprise with a diversified stream of earnings. With the aid of Chase, Morrison, and the employees of the textile operation, Berkshire slowly reduced its investment in textiles. Monies raised by selling off plant and equipment and shrinking investments in receivables and inventories were recycled into more profitable investments in operating businesses, such as National Indemnity and Illinois National Bank, and into marketable securities. The liquidation of the textile operations in 1985 and 1986 was the end of an era. What began as an association with the country's first mill operators and continued for almost 2 centuries in various forms ended with a money-losing fire sale. Although its original business of textiles was no longer part of the picture, the story of those who built Berkshire Hathaway would always have a place in history because of Warren Buffett. 3 very good businesses, and a few thoughts about incentive compensation. As the textile business faded into history, the businesses it spawned flourished. Buffett used some figures on Nebraska Furniture Mart, See's, and the Buffalo News to opine on incentive compensation. It was also an excellent lesson on business economics and the importance of thinking through facts and figures carefully. The 3 businesses just mentioned earned $72 million pre-tax for Berkshire Hathaway in 1985 and represented about half of pre-tax operating earnings, prior to interest expense, for that year. Those businesses were earning about $8 million 15 years ago before Berkshire purchased any of them. Buffett cautioned against seeing such an increase as automatically good. That record was good, but there was information missing. To properly appreciate the economic characteristics of a business and whether growth is good, it must properly be compared to the capital required to produce those earnings. The Buffalo News, See's, and Nebraska Furniture Mart, the incremental return on capital investment was highly satisfactory, said Buffett, being understated as usual. Doing some simple math illustrated the excellent economics of those businesses. The rate of return pre-tax was 160%. See Table 5.5. This result stands out when compared to other businesses Berkshire could have purchased. The average American business has required about $5 of additional capital to generate an additional $1 of annual pre-tax earnings, he said. Such a rate of return of 20% pre-tax was not a poor result, but it wasn't 160% either. The only problem, if it could be called one, was the businesses possessed such low reinvestment requirements that they could hardly reinvest their earnings. In 15 years, those businesses found opportunities to invest just $40 million. Berkshire would have invested another $40 million if it could find another close to the 160% incremental return seen over the previous 15 years. Instead, they shipped the excess cash off to Omaha for reallocation into other investment opportunities. Nebraska Furniture Mart was a low-cost operation with one location. This allowed it to set prices below its competitors and still earn a good result for its owners. See's, though still an excellent business, continued to face the industry headwind of declining per capita consumption of boxed chocolates. Declining pounds meant per-pound cost pressures, which were difficult to fully compensate through price increases. The Buffalo News, with exceptional penetration rates near 80%, had little room for future growth within its territory. It could expand advertising with preprints, advertisers supplying inserts versus on-page advertisements, but those were less profitable and subject to competition. The common thread with all 3 was exceptional management. Buffett was not opposed to paying large sums for above-average performance, but he disliked compensation for average performance. He thought managers whose companies increased earnings at the same pace as capital invested in the business deserved no applause. These average managers, and those compensating them, focused blindly on increased dollar earnings. What mattered more was the rate of change. An ordinary savings account provided an ultra-simplified example. An account earning 8% would quadruple its annual earnings in 18 years. The manager of the account would have done nothing but sit back and let the interest accumulate and compound. The above-average manager found ways to increase value. Value enhancement might come in the form of increasing the rate of return on capital through better margins, or perhaps by conducting the same level of operations with less capital. It could also come in the form of expanding a difficult-to-grow business while maintaining good rates of return on capital. Another way to make money doing nothing was with fixed-priced options for company shares. Managers who issued themselves such options were incented to retain earnings even if it made more sense to pay out some or all of them to shareholders. The larger the pie at the end of their option period, the bigger their payout. This really got Buffett's blood boiling. Buffett wanted managers to think and act like owners. He said owners would understand that there was a cost to capital and that rates of return mattered more than simply increasing earnings. He also thought options should only be issued to those responsible for the overall performance of the business. Though Berkshire didn't issue options, he thought it entirely appropriate for the manager of a well-performing subsidiary to receive a large bonus, even though Berkshire overall performed poorly in comparison. Conversely, a well-performing Berkshire would not automatically mean a big check if the individual unit performed poorly. Many other corporations acted against this rational approach. Their owners paid for it quite literally by giving up a portion of their interest to the managers. Insurance operations. The insurance industry presented another perplexing year in 1985. Despite an estimated 20.9% increase in premium volumes, combined ratios remained elevated. The 1985 estimated industry combined ratio of 118% and Berkshire's own overall ratio of 105% was because losses remained high. Part of the problem was the persistent social inflation where judges and juries awarded far more than insurers had priced into policies. The real issue